Hey guys, welcome back to another video. Today we're going to be talking about takeover tactics. And these are types of tactics that are employed when a acquirer makes a hostile bid for a target company. Now there are two bids in a transaction. There's the friendly bid and then there's the hostile bid. The friendly bid is where the acquirer approaches the target, really brings up the issue of I'd like to buy you or I'd like to merge with you, and then the target company opens up the books through the due diligence process and signs a confidentiality agreement. Of course, they kind of walk through the company and explain to the acquirer what they're going to buy, right? And so they have a little bit more of an internal view on the company before they make their final bid. With a hostile bid, though, the management team of the target company is resistant to being acquired and they will not open up to the acquirer. So really the acquirer only has the information that's publicly available to work off of. And so these are tactics employed to really increase the leverage and power of the buying power of the acquirer in a situation where the target company is resistant to being acquired. Now, this topic is covered in Chapter 6 of the M&A and Corporate Restructuring 4th edition book by Patrick A. Gaunt. So I've provided a link in the video description for you to check that book out. But let's get started. So, in the 1980s, as hostile takeovers reached new heights of intensity, targets became wary and bidders were required to advance the sophistication of their takeover tactics. Unfortunately, the options for the hostile bidder are fewer in number compared with the broad variety of defenses that targets implement in advance of and during a hostile bid. And I've already covered the Chapter 5 of this book, the takeover defense side of the discussion, so you can check that on my channel, but this is more of the offensive side. So we're flipping the perspective and we're now focusing on the acquirers rather than the target. Now, just to kind of, stimulate your interest a little bit, some key figures within the 1980s that were very, very well known to use these tactics. Probably the most well known was Carl Icahn. He's still doing it today. He's an activist shareholder, and he's a type of bullish investor that gets involved with companies. Back in the day, companies would throw up these defenses, but now, he can just acquire a company's shares and sit on the board and kind of dictate that way. But when management was much more resistant in the 1980s, these were tactics Carl Icahn wanted to employ. Also, if you know Playboy Dan Bilzerian, his father, Paul Bilzerian, was a takeover artist, who really employed majority of these tactics. So there are many, many figures, very famous investors who have used these tactics, and they've become legitimized since the 1980s. Now, the bidder is typically left with a choice of three main takeover tactics: a bear hug, a tender offer, and a proxy fight. In addition, each may be implemented in varying manners to increase the likelihood of success. These options and the related shareholder wealth effects will be the focus of this video. So these are the three takeover tactics: the bear hug, the tender offer, the proxy fight. And so we'll take a look at each of them. So first of all, establishing a toehold. An initial step that is often pursued before using the various takeover tactics that are at the disposal of a hostile bidder is to begin an initial accumulation of the target's shares. One of the advantages of such share purchases is that if the market is unaware of its actions, the bidder may be able to avoid the payment of a premium. This lowers the average cost of the acquisition. In addition, it may provide the bidder with some of the same rights that other shareholders have. It is interesting to note that there is some evidence that despite the theoretical benefits of establishing a toehold prior to initiating a tender offer, most bidders do not utilize toehold share accumulations. Bidders have to disclose their holdings within 10 days after acquiring 5% of a target stock. This allows them to possibly accumulate a significantly higher percentage of shares than the 5% level set forth in the Williams Act. Surprisingly, in addition to the fact that most bidders do not establish a toehold, most hold fewer shares than they could anonymously accumulate in that 10-day period after they hit that 5% threshold. So this is a very, very important rule. When any type of shareholder acquires 5% of the company's outstanding shares, they have to disclose publicly, according to the Williams Act, that they have accumulated that amount, X amount of shares in that company, after 10 days. So you spend X amount of days, acquiring up to 5% of the company, and then you have 10 more days to buy as much as you can before you really have to publicly disclose your position. For a hostile bidder, this is very, very important because, if you had 100 days instead of 10 days, then it would be much easier. But with 10 days as a hostile bidder, you got to get in there and quickly establish a position in the company before the company's management realizes that you're the one buying those shares and that, you are interested in really taking them over and probably them losing their jobs. So they're going to be defensive the moment they find out. Now, there are other ways for them to find out, just looking at the buying patterns of shares, but we'll focus on just the basics. Once you disclose, the management team knows that you're there. They know that you're interested because you've accumulated such a large position. And back in the 1980s, they would become very defensive very fast. So the fact that toeholds are not used even more frequently and fully is surprising in light of the research that toeholds result in lower tender offer premiums. Most of this analysis in this area just focused on the benefits of establishing a toehold while not considering all of the potential costs, including those that might occur in the event that the bid was a failure. This could put significant pressure on the stock and result in huge losses. So even though establishing a toehold by first buying up a little bit of stock and then initiating a tender offer is effective in kind of reducing the premium paid on that tender offer, the problem is if your tender offer fails and you don't meet the required threshold of investors who will tender their shares to your offer, then what happens is you end up holding this minority position in a company that doesn't want you there. And so you can kind of hold on, and maybe after 4 or 5 years after the company has settled again and found some positive ground and increased the stock price, you might get out at a profit. But majority of the time, if you get caught with a failed tender offer, the stock falls and you lose a lot because you hold a position in that company. So that's the downside, and that's why a lot of raiders don't use this tactic of establishing a toehold. Now, what about the casual pass? Before initiating hostile actions, the bidder may attempt some informal overture to the management of the target. This is sometimes referred to as a casual pass. It may come from a member of the bidder's management or from one of its representatives, such as the investment banker. It can work against the bidder because it provides the target with advance warning of the bidder's interest. So essentially, the casual pass is a fancy term for just saying, I'm approaching the management team. I'm like, hey, I'm interested in buying your company and firing you guys. Are you comfortable with that? Oh, well, no, sir. I don't want to lose my multi-million-dollar job. Well, it's not the most effective way. Usually it's not used. But in certain instances where the bidder feels they can convince management to turn from hostile to friendly, the casual pass can be effective. Now, the first main takeover tactic, the bear hug. A bidder will sometimes try to pressure the management of the target before initiating a tender offer. This may be done by contacting the board of directors with an expression of interest in acquiring the target and the implied intent to go directly to stockholders with a tender offer if these overtures are not favorably received. This strategy is known as the bear hug and may also be accompanied by a public announcement of the bidder's intent to make a tender offer. So unlike a casual pass where you just approach the management and you say, hey, I'm interested in your company, with a bear hug, it's really a threat. You have a tender offer, you have the money available for that tender offer, you approach the management team and you're like, hey, you know what? I'm interested in buying your company. Now you can deal with me right now privately and in a friendly manner, but if you will deem me hostile, I will go over you and I'll directly conduct a tender offer directly to your shareholders. With a tender offer, you don't have to go through management. Management can reject the tender offer, but as long as shareholders tender their shares enough so that that person reaches their significant threshold of shareholding. So if they're tendering 50% of the company's shares, at least 50% of the existing shareholders need to tender their shares, which means that they commit to receiving that payment from the tender offer. In that scenario, it's successful, right? And so it is a big threat, and that's why the bear hug is very effective, because it puts pressure on the management team to A, either react and kind of change a few things within the company, and B, deal in a friendly manner with that hostile bidder. Now, a bear hug also puts pressure on the board of directors because it must be considered lest the board be regarded as having violated its fiduciary duties. So under Delaware law, the duty of the board is to act in the best interest of maximizing shareholder value. If they are approached by a hostile bidder with a significant premium, they can't just turn around and say no. they can throw out some defenses which will drive up the price of that acquisition. But if it's such a significant premium and then the bidder feels that management is biased, they can sue the board of directors and argue in court that they interfered with my bid, and it was unfairly viewed in light of me being hostile rather than me maximizing the shareholder value, right? And so it's a delicate process. That's why bear hugs are so effective. A stronger version of the standard bear hug occurs when one bidder offers a specific price in order to, among other reasons, establish a range for damages and possible stockholder lawsuits that may follow the target management's rejection of the bid. Like I said, this tactic increases the pressure on the target's board, which might be the object of the lawsuits. Now, the typical reason of an unreceptive target board is to acquire a fairness opinion from an investment bank that will say that the offer is inadequate. So that's the best way to approach it from the management side. The bear hug is initiated, the management team contacts an investment bank, and right away conduct a fairness opinion, value us, and then we compare what you provided as an unbiased value relative to what we received. If the unbiased value is higher than the bid, we can easily reject it and defend our decision in court. Now, this gives the board of directors a legitimate reason to reject the offer. From a strategic point of view, if the bidder sees a realistic possibility of a negotiated transaction, the bear hug may be an attractive alternative to a tender offer. It is less expensive and less time-consuming way to conduct a hostile acquisition. It may also reduce the adverse consequences that sometimes are associated with hostile deals, such as the loss of key target employees and a deterioration of employee morale following the acquisition. So unlike a tender offer where there's a lot of internal conflict within the company as to whether we should really tender our shares or not, or whether it's fair or not, and at the same time that fear of losing your job as a hostile bidder really acquires the company, with a bear hug it's much more private. Not a lot of people know about it outside of the C-suite and the board of directors, right? So when the hostile bidder approaches and the bear hug is effective in at least turning those negotiations into more friendly rather than hostile manner, you save a lot of face and a lot of publicity or surrounding the deal. Now, what about tender offers, the second way? Now, because the thing is, there's no specific definition of a tender offer. That's the confusing part. But a simple explanation of what a tender offer is the tender offer is a public, open offer or invitation, usually announced in a newspaper or advertisement by a prospective acquirer to all stockholders of a publicly traded corporation, the target corporation, to tender their stock for sale at a specified price during a specified time. So a tender offer, I am a hostile bidder, you are the company shareholders, I approach you, you're currently trading at $25 a share, I conduct a tender offer at $50 a share, and I'm setting a minimum threshold of 50% of shares to be tendered to me, and that is considered successful. So if 50% or more people tender their shares to my offer of $50, which is double the current share price, then I will execute that transaction and complete and acquire those shares. If I don't meet that, then I don't buy those shares. And what happens is I cancel the tender offer and I just either move on with my tail in between my feet, or I increase the premium once again and I go up to $75 instead of $50. Now, the Williams Act, which regulates the tender offer, doesn't offer an exact definition, however. Instead, there are 8 factors which are characteristics of a tender offer. Not all 8 factors need to be present, however. It is decided given each individual circumstance. So the 8 factors, which at least some of them need to be present in order for an offer to be considered a tender offer, is that 1, active and widespread solicitation of public shareholders for the shares of an issuer. The solicitation made for the substantial percentage of an issuer's stock. So not only am I speaking directly to all shareholders, but I'm asking for a substantial percentage of the shareholder stock. I offer to purchase at a premium, so it's currently trading at 25, and I'm offering at 50. If I were to offer exactly the same price, that would not be considered a tender offer. Now, the terms of the offer firm are firm rather than negotiated, so it's a take it or leave it bargain. Like the tender offer is not negotiable. You can't approach the bidder and be like, hey, can you buy it at 55? No, either you accept it or you don't. The offer is contingent on the tender of a fixed number of shares, so meeting that minimum threshold. The offer is open for a limited time, so usually that offer ranges between 2 to 3 weeks. And the offeree is subject to pressure to sell their stock. So the offeree, the shareholders, feels that pressure in order to realize that gain. Right, it's double the current share price. I feel a significant inclination to really tender my shares due to that premium. And the public announcements of a purchasing program concerning the target company precede or accompany rapid accumulation of larger amounts of the company's securities. So essentially, if you see that there's a significant amount of buying in the public markets of those securities, then that means, especially from the bidder's perspective, that this is considered a tender offer. They're executing a significant buying pressure on the company. They're pushing up the stock, and that is considered part of the tender offer. Now, I'd say the most common factors. One is the widespread solicitation. So it's important that the tender offer is known publicly to all shareholders, because that's the effective way to really get the most tendered shares. It's made at a substantial premium, and at the same time, it's a take it or leave it agreement, and they have to meet a fixed threshold. And so that's a very common way of defining the tender offer. But there are other really more borderline offers that, in some cases can be negotiated. It can really be considered a tender offer, in some instances cannot, right? And so that comes up down to the court and the ruling of the judge. Now, open market purchases. The courts have generally found that open market purchases do not by themselves represent a tender offer. And just going back here, we have the purchasing program. So we have a lot of buying pressure from the bidder. But at the same time, there's not widespread solicitation. It's not a take it or leave it agreement. So open market purchases is not considered a tender offer. Now, one version of open market purchases is a creeping tender offer, which is the process of gradually acquiring shares in the market or through private transactions. However, the courts have maintained that a publicly announced intention to acquire control of a company followed by a rapid accumulation of the firm's stock is a tender offer. And so that is number one, active and widespread solicitation of public shareholders for the shares of an issuer. So if you are going to announce and all the shareholders know that, Finance Kid is interested in acquiring 50% of this company and I'm going to be buying this stock, that can be considered a tender offer. Now, reason for using a tender offer. A company usually resorts to a tender offer when a friendly negotiated transaction does not appear to be a viable alternative. And using a tender offer, the bidder may be able to circumvent management and obtain control even when the managers oppose the takeover. The costs associated with a tender offer, such as legal filing fees and publication costs, make the tender offer a more expensive alternative than a negotiated deal or a bear hug. Now, just to comment on this, legal filing fees, you have a lot of different players within, that the tender offer process, which we'll talk about later, but publication costs. So that solicitation of shareholders, that announcement that I'm interested in buying, Finance Kid is interested in buying 50% of the shares, requires a lot of advertising. So back in the day, you saw a lot of newspaper articles in the Times, in the Wall Street Journal, of a lot of these bidders who would take out these full-page ads announcing to shareholders that, tender your shares to my offer because it's so significant and you won't be able to realize such a significant gain in the future and blah, 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 and all that. And that costs a lot of money. So the tender offer is a more effective way of getting around management, but it is also much more expensive than just a negotiated or bear hug strategy. Now, what about the success rate? Most offers are not contested. Based on experience in the years from 1990 to 2005, the success rate of total contested tender offers for publicly traded companies was 55% on a weighted average basis. White knights accounted for a significant percentage of the instances in which targets fought off the original hostile bidder. And so majority of the time, the typical reaction of a board when they receive a tender offer is they start looking for a white knight. They're like, shit, okay, we got to figure out who can really buy us, who we consider friendly rather than hostile. And I mean, I struggle with this as well when I was thinking about what makes a hostile bidder hostile. Like, if you're really just going to buy out my stock, I don't care whether you're hostile or friendly, right? So from the shareholder's perspective, it's much less of a concern. But for management, especially when management fears losing their jobs or they fear that the company will be sold piece by piece for parts and taken apart or liquidated or something like that, that's when the board of directors feel that really they should seek a white knight to ensure the protection of the company's assets and really the stability of its strategy, right? Because a lot of the time with hostile bidders, such as Carl Icahn or Paul Blazarian, they would come in, they'd sell off big pieces to pay down the debt that they used to acquire the company, and the remaining pieces, it would be really stripped down to the bare bones in order to generate as much cash to pay down the remaining debt. Because that was the 1980s. You could literally buy a company with 5% equity, 95% debt, right? And so that destroyed a lot of companies. But now, in the present, in the 2000s and in 2010, the tender offer is a significantly different type of offer. So majority of the time, you won't see a lot of companies seeking white knights anymore. But back in the day, that was the case. And also looking at that percentage, that success rate, 55% is completely fair. Rather than just making an offer and hoping that it's the best, the tender offer seems like it is. It leans towards being more successful than a failure. So what about cash versus securities tender offers? So the firm that is initiating a tender offer may go with an all-cash tender offer or may use securities as part or all of the consideration used for the offer. Securities may be more attractive to some of the target shareholders because under certain circumstances, the transaction may be considered tax-free. And this is because when you sell your shares, and if it's real, you sell them at a profit, you pay a capital gains tax on that, right? Because you receive cash. But if you receive stock instead of cash, and you're really essentially transferring one share for another, or for 2.5 or whatever many shares, that is tax-free because you're not paying any capital gains on that transfer. Now, the bidding firm may create a more flexible structure for target shareholders by using a double barrel offer, which is an offer in which the target shareholders are given the option of receiving cash or securities in exchange for their shares. Now, that 10-day window. The Williams Act requires the purchasers of 5% of the outstanding shares of a company's stock register with the SEC within 10 days by filing a Schedule TO. It is in the bidder's interest to purchase shares as quickly as possible during the 10-day period after the acquirer reaches the 5% share threshold. The 10-day window gives the bidder an opportunity to purchase a larger amount of stock without having to pay the post-filing premium. And so really the downside, the moment that a bidder has to disclose publicly that they're buying shares, there's interest. There's a lot of arbitrage traders who will step in, buy stock in anticipation for that bidder to make a offer at a premium. And so what happens is, yes, they're buying they're buying interest alone when they're buying this 5%. The 5% of the outstanding shares does push up the stock incrementally, not significantly if they do it correctly. But the moment that the public knows that someone is very, very interested in maybe doing a creeping tender offer or acquiring a significant percentage of a company, similar to when Buffett announces that he holds shares in a company, the stock jumps in anticipation of the future performance of that company, whether they'll be acquired or whether there'll be significant and positive changes for shareholders. And that means that it becomes more costly. And that's why bidders the moment they hit that 5% threshold, they need to rush quickly in order to avoid buying more stock at a significant premium. Now, by resisting the bid, the target may be able to force the bidder to raise its offer. The target may also be able to attract other bidders to start an auction process in which one bid drives up the value of the other bid and really drives up the total value of the company. If the premium offered reflects a value that is in excess of that which could be realized by shareholders by keeping the company independent, then resistance reduces value and majority of the time management just gives in. And there are certain instances where there are some suckers, some hostile bidders who really overpaid. And management realized that, and they're just like, okay, take it. Our holdings within the company alone will really kind of help us realize a lot of a personal profit because the bid was so significant. In other instances, especially for a lot of management that resists that bid, they then either seek a white knight to really start that auction process, or they throw up defenses in the different anti-takeover defenses, which we talked about in Chapter 5 in the previous video, to drive up the price in order for the bidder to offer an even higher premium. Now let's look at the key participants within the tender offer team. So if I'm Paul Blazarian and I'm interested in making a tender offer, I need an investment bank, which provides the financing and advisory services throughout the bidding process. I need my legal advisors, which provide legal advice and knowledge in takeover tactics. I need my information agent, which is responsible for forwarding tender offer materials to stockholders. That's very important for the solicitation of the public shareholders. I need a depository bank, which handles the receipt of the tender offers and the payments of the shares tendered, and a forwarding agent, which enhances the resources of the depository bank and transmit tenders received to the depository bank. So really these two are kind of related. So the depository and forwarding agent, the depository actually handles the payment of tendered shares, whereas the forwarding agent really provides a much more larger reach for shareholders. So if shareholders are international, so it's not just US based shareholders but international shareholders, then you might need forwarding agents in other countries to then really help complete the transaction for the depository bank. Now, the two-tiered tender offer. A two-tiered tender offer is sometimes referred to as a front-end loaded tender offer. It provides for superior compensation for a first-step purchase, followed by inferior compensation for the second tier or the back end of the transaction. If insufficient shares are tendered in the first tier, and if the merger or acquisition is approved, the remaining shareholders can be frozen out of their positions and may have to tender their shares for the inferior compensation in the back end. So really with the two-tier tender offer, what's really strong about this is that it incentivizes shareholders to tender in the first tier rather than get caught in the second tier. So if management offers a two-tier offer, where the first side, again, we're thinking back to that company, it's currently trading at 25, and in the first tier, the offer is $50 a share, a lot of people are going to feel pressure. Yeah, let's that's a great premium. Let's tender. But for the people who really hold out, who believe that no, management's going to protect our interests and they're going to try to increase the value, but all of a sudden, the deal does get approved, well, now they can only tender their shares at maybe $30 or even $25 at the current share price for in the second back end side, right? So that's really what's really effective. You don't need 100% of shareholders tendering their shares. You need maybe a super majority, which is between 90 and 95%. So the remaining 5 to 10% can get frozen out and they receive inferior compensation for their shares. And that's why that fear of getting caught in the back end is what drives a lot of shareholders to tender their shares in the front end. Now, results showed that stockholders do as well when confronted with a front-end loaded bid when they have an any and all offer. In a recent study, the average premium for the 144 any and all offers was 56.6%, whereas the average premium for the 39 two-tiered offers in this research sample, was 55.9%. So what this essentially means is that the difference between just doing a normal tender offer and a two-tier tender offer, the premium is very similar. It's slightly a little higher for the two-tier tender offer, but the premium relative to the before announcement trading price is very similar, around 50%. Now, corporate charter amendments, including fair price provisions, have combined with the passage of specific state laws to limit the effectiveness of two-tier bids. So essentially, we talked about this in the previous video, that fair price provision is an amendment within the charter, which really provides a lower base, a lower threshold for the lowest price possible that a bidder could offer for the company's shares. And so the higher that price provision is, then really the less effective the two-tiered offer is, the back end of that offer, right? So majority of the time when you talk about inferior compensation in the back end, really that's protected by the fair price provision, ensuring that shareholders at least get something in the form of compensation in the back end. Now, what about the three-piece suitor? Transactions are sometimes structured in 3 steps. A bidder using a 3-step transaction is sometimes referred to as a three-piece suitor. The general process for such transactions involves the bidder making an initial stock purchase, followed by a second-step tender offer. So you buy stock in the company, and then you conduct that two-tiered tender offer. So you buy stock, step 1, and then you conduct the following 2 steps through the two-tiered tender offer. Now, once control is established and a majority of the shareholders have tendered their shares in the tender offer, a third step freeze-out purchase of the minority shareholders who have not tendered their shares is conducted. Right? So you buy stock in the company, you then really offer a significant premium in the front end, and in the back end you freeze out the people who held out, the remaining shareholders. Now, what are the wealth effects of unsuccessful tender offers? Although the premium associated with a successful bid may increase the target shareholder's wealth, The question exists whether the increase in the target shares caused by the announcement of a bid persists when the bid fails. So in a scenario where the tender offer does not reach that required threshold, what happens? Will the cumulative abnormal effects or returns show a positive revaluation of the target shares, which does not dissipate subsequent to the rejection of the offer? So the moment the tender offer is submitted, there is a revaluation of those shares. So if the hostile bidder feels that the company was undervalued by $5, and they offer a $10 premium, really when the tender offer fails, the market will attempt to revalue that company to see what did the bidder see in that company. And so shares are revalued and kind of stay around that level. And so that's what you can kind of see over here at the total. Now, what about the bidder? Well, if the bidder fails in its tender offer and the target does not see a change in control, the cumulative abnormal returns for the bidding firms remain non-negative. However, when the target is acquired by another bidder and the bidder in question loses the tender offer, the value of the bidding firm falls significantly. So really, there's two scenarios. If for the bidder, especially if it's a publicly traded company, if they make a tender offer and it fails, and then the target company just continues on and working and doing their own thing, then there's no real change in the value of their stock. However, if they've conducted a tender offer, they fail, and all of a sudden there's another bidder who wins, so they either conduct a higher tender offer, so they offer a more significant premium, or it really gets into an auction process and the bidder loses, well, then the bidder's stock falls significantly. So that's really the two paths that can happen. Now, finance theorists have contended that the more independent a board is, the greater the return to shareholders. They found that targets of tender offers experience shareholder gains that are 20% higher when the board is independent compared with less independent tender offer targets. These findings suggest that independent directors are more active supporters of shareholder value than non-independent directors. And so this is really important when you think about companies who really operate in different sectors. So if you have if you have the bidder who operates in a completely different industry, and then you have the target company, which is in another industry. Now, it's important that the target company has different perspectives really on that board. If you have a very focused and narrow mindset and perspective, the board itself in aggregate, then they'll probably concede when there is buying pressure. But if it's very independent and they feel that they know the business very well and they have a great lay of the land, especially when they understand the bidder and they understand the capabilities of the bidder, then the more independent that board is, the higher the premium is, because the board feels they can negotiate and really increase the value of the shares and the premium offered in the bid. Now, when considering the relationship between the acquisitions and subsequent divestitures, researchers have found a statistically significant negative stock price response, on average of 24%, to acquisitions that were subsequently divested. So in a scenario where a tender offer is conducted, acquired, and all of a sudden they divest that after a few months or years, there's an average negative stock price fall of 24%. For acquisitions that were not divested, they found a small, not statistically significant, positive stock price response, on average of 1.9%. The import of this result is that it seems that at the time of the acquisition announcement, the market is making a prediction regarding when acquisitions are good and which are bad. So in a scenario where really the announcement and the deal is completed, the share price reveals a lot about whether the deal is successful. The market is incredibly efficient in predicting the success rate of that deal. And so if you see that the acquirer's stock price falls significantly, then you can really draw the conclusion that it seems that the market is very pessimistic with regards to the potential of this deal. If on average the stock remains in the same level and only incrementally increases, then the deal seems to have gone correctly and it will be implemented successfully. Now, a hostile bidder may accumulate stock in the target before making a tender offer. As noted previously, the purchaser usually tries to keep these initial purchases secret to put as little upward pressure as possible on the target stock price. To do so, the acquisitions are often made through various shell corporations and partnerships whose names do not convey the true identity of the ultimate purchaser. And we talked about this with the creeping tender offer. Upon reaching the 5% threshold, the purchaser has 10 days before it is necessary to make a public disclosure. This time may be used to augment the bidder's stock holdings. If a bidder engages in an aggressive purchasing program, it is not unusual for the bidder to acquire up to 20% of a target. So in a scenario where they hit that 5% threshold, for the next 10 days, they can be very, very aggressive and drive up really their holdings to about 20%. But of course, that buying pressure will increase the stock incrementally. The use of street sweeps as an effective takeover tactic was pioneered in 1985 by Hansen Trust plc. In that year, Hansen Trust terminated its tender offer for SCM Corporation and immediately bought 25% of SCM's outstanding stock from arbitrageurs in just 6 transactions. So we talked about this. The effectiveness of the Williams Act, which defines this 5% threshold, is that people don't know that you're interested in acquiring stock in the company. However, the moment they find out, a bidder will see that majority of the time these arbitrageurs will step in and begin to start holding this stock in anticipation of being paid out at a premium. Now, if they conduct a tender offer and it doesn't work, what really happens is majority of the time, the shares will be concentrated with these arbitrageurs because they'll be providing a market for people who are interested in selling their shares, right? And so they'll hold a big really swath of the stock. And so in a scenario where the bidder still feels, hey, you know what, I still want to acquire shares, I'm going to kind of either cancel my tender offer, not pursue a tender offer, you can go directly to the arbitrageurs and just buy stock from them directly because they have a lot of it. And that's considered a street sweep. Now, pursuant to Rule 14b, Section 5, an offeror that has initiated an active tender offer is prohibited from purchasing shares outside of the tender offer as long as it is still active. So looking at the previous example, you had Hansen Trust, who had a tender offer, but they pulled it back, they canceled it, and then engaged in these 6 transactions to buy 25% of SCM's outstanding stock. But if you are in a tender offer, you cannot buy shares outside of the TO. The ruling also highlights a loophole in the Williams Act that renders targets vulnerable to street sweeps following an attempted tender offer because of the concentration of shares in the hands of arbitrageurs, which increases the probability of success for a street sweep. And so that's really the downside to that rule. But again, it's not without cost because street sweeps, they're going to be selling at a premium. Arbitrageurs are investors. They're in it for the profit. So they're going to really hold out and you're going to have to pay a significant premium to really acquire those shares. So it will cost a little bit more, but it is a very successful way of acquiring a lot of stock in a short period of time. Now, from the bidder's perspective, the fact that shares become concentrated into the hands of arbitrageurs is a positive development. These shareholders have no loyalty to the target and actually want the deal to be completed in order for them to get paid out. Now, the costs of the tender offer are clearly higher than the brokerage fees of open market purchases. The clear drawback for open market moves is that the bidder who purchases shares in the market is not guaranteed that he will be able to accumulate sufficient shares to acquire clear control. So with the tender offer, if the tender offer is unsuccessful, then they don't have to tender those shares. But with open market purchases, you're really buying that stock right away. So you own the stock that you've committed to. Whereas with the tender offer, if you don't meet that threshold, you're not entitled to really meet that commitment, right? So there's a downside to the open market purchases relative to the tender offers, even though open market purchases cost less. If a 51% clear control is not achieved in the company, the bidder may be stuck in an undesirable minority position, which majority of the time trades at a discount. So for them to exit out of a minority position rather than a majority position, they really might have to take some losses. And so that's the downside to open market purchases. Now, the third and really the final takeover tactic is a proxy fight. Now, a proxy fight is an attempt by a single shareholder or a group of shareholders to take control or bring about other changes in a company through the use of the proxy mechanism of corporate voting. In a proxy fight, a bidder may attempt to use his voting rights and garner support from other shareholders to oust the incumbent board and or management team. An important part of proxy fights are the board members themselves. Corporate elections for seats on the board of directors are typically held once a year at the annual stockholders meeting. The board of directors is particularly important to the corporation because the board selects the management, which in turn runs the corporation on a day-to-day basis. Most shareholders vote with their feet, so there's a lack of presence from a large group of owners at these elections. Surprisingly, larger institutions also display this apathy sometimes. So with corporate elections, majority of the time, the success of corporate elections depends on the involvement of shareholders. If majority of the time shareholders and institutional investors will lean towards supporting management because it's in their interest to really make sure that management likes them. But at the same time, in a scenario where the shareholders are not as involved, majority of the time they won't even participate in these corporate elections. And so in a proxy fight, it's much easier for the bidder to really acquire stock, set a election date to really vote in new board members and really take control of the board and then eventually take control of management. This is a very lengthy process relative to the tender offer or the bear hug, but it is much more effective and cheaper to really take control of the company because they don't even have to buy a majority share of the company. Now, smaller individual shareholders are naturally apathetic given their share of ownership in the company, but surprisingly, larger institutional shareholders often display similar apathy. However, institutional investors have often sided with management. Indeed, some corporations pressure institutions to side with them against insurgents because majority of the time, if these institutional investors also offer commercial banking or investment banking services, when those corporations and that management team seeks those services, they want to make sure that, did you guys support us in our last proxy fight? If you didn't, then they probably won't do business with you, right? So there's a little bit of a double-edged sword there. So that's why they kind of lean towards management more than the hostile bidders. Now, stockholders who turn over their portfolios often may keep their stocks in their brokerage firm's account, which is considered the street name, right? So the brokerage firm will be the name under which the shares are held to expedite the registration of their securities. Many stockholders decide they do not want to be bothered with keeping their share certificates and simply leave their shares with the broker, who keeps them in the firm's name. Often, shareholders do not give their brokers voting instructions, so they don't tell them to either side with management or don't. When this happens, brokers often choose to vote for the directors proposed by management, or they just completely absolve themselves from the voting process. Now, there are two main proxy contests. There's the contest for seats on the board of directors, or there's contests about management proposals. In a proxy contest, an insurgent group attempts to wrest control of the target by gathering enough supporting votes to replace the current board with board members of the group's choosing. The following improve their odds. So with insufficient voting support for management, either poor operating performance or no real sound operating plan, and the bidder proposes a very sound alternative operating plan, what really happens is it becomes very easy to take over the board, really for the bidder to really vote in their own people onto the board in order to bring about that change. So it is a successful way, and a very public example is CP Rail and Bill Ackman, how he took over the company by really getting involved in the voting process. So he conducted a proxy contest. He put his guys on the board, so the guys that really supported his interests, and that's how they really changed about the management team. Now, the longer term effects of proxy contests, they're really positive. So more recent research further confirmed the positive shareholder wealth effects of prior studies. In a large study of 270 proxy contests that occurred between 1979 and 1994, researchers found that proxy contests help create shareholder value. They traced most of these gains to the acquisition of the firms that occurred around the contest period. Gains were even found, however, when the company was not acquired if the firm experienced management turnover. So majority of the time, if you have these hostile bidders or just any activist investors getting involved with the company, majority of the time they've done their research. They know and they have the experience to realize that if you change this thing and then you move around these assets, you can really unlock some additional shareholder value. And so what happens is that majority of the time, proxy contests result in positive shareholder votes. And that's why either shareholders don't get involved, minority shareholders, or they support the bidder, especially in very public instances. So that Bill Ackman example with CP Rail, a lot of shareholders voted in Bill Ackman's favor. Now, there was a D'Angelo study which found that dissidents prevailed in 1/3 of the contests in their sample, whereas another 1/3 of the companies had changes in top management within 3 years of the contest, with most of these changes occurring the first year. In addition, they found that only 20% of the sample firms remained independent, publicly held companies run by the same management team that was in place before the proxy fight. So even in a scenario where a activist investor or hostile bidder engages in a proxy contest and they fail, only 20% of the time does the firm really go and remain unchanged. There are more than 2/3 of the time you'll see that there are significant changes at the top, or there's changes in strategy, because the management team, which really kind of defended against the hostile bidder, they will then have to report to the board of directors, who will then turn to them and say, hey, are they right at all? Is that guy right? Was he right about, us changing that and that and that? And eventually they'll realize that they have to do something in order to at least prove to the board of directors, the people that they report to, that they are still worth their jobs, right? That they still want to keep their jobs and really operate in the best interest of their companies. So what really proxy vote contests do is either they really completely change the board of directors, so the hostile bidder really votes in their own people, and then they really fire the management team, and the hostile bidder puts in their own management team and takes control of the company, or it really gets it wakens up the lazy management teams of different companies that have become complacent, that have really sat back and trusted that their board of directors will always support them. Because once you start raising questions with regards to the effectiveness of management, the board of directors will then look at management and be like, is that true? Or show us that it's not true. And that's why that change does often come about. So once again, a quick overview of the takeover tactics. We have the bear hug, which is going to the management team and threatening the management team that unless they deal with them in a more friendly manner, they will conduct the hostile bidder will conduct a tender offer and go directly to shareholders. There's the actual tender offer itself, which is defined based on 8 factors within the Williams Act. And there's the proxy fight, which either you can take control of management, or you can get the management team to be fired by taking over the board of directors. Other than that, that's pretty much it for this video. As always, if you have any questions or comments, please do comment below and I'll be sure to get back to you as soon as possible. If you did find the video helpful, please do like and subscribe to the channel for more videos. As always, guys, have a nice day.